Have you ever wondered if there's an investment strategy that seamlessly blends dividend income with long-term growth potential? It's a common question for investors. As with investing, there are only two goals: securing a steady stream of dividend income and achieving long-term growth. These goals are pillars upon which many investors build their portfolios, aiming for a blend that promises immediate rewards and future prosperity. Yet, navigating the investment landscape to meet these objectives is no small feat. It introduces a complex puzzle where pursuing high dividend yields often seem at odds with the goal of capital appreciation. A prime illustration of this is seen with covered call ETFs. These ETFs are a fascinating breed of investments that employ a unique strategy to marry dividends with growth. These ETFs utilize covered calls to generate premiums, which are then distributed to investors as dividends, sometimes yielding as much as 10 to 12%. However, this generous dividend yield often comes at the expense of capital appreciation, leading to underperformance relative to the broader market, a problem for many investors. So, how does one achieve the best of both worlds? Can you blend dividend income and growth seamlessly into a single investment vehicle? Well, let's find out. Understanding dividend income versus capital appreciation. As an investor, it's normal to want a dividend income and capital appreciation. For those who are not well versed on these terms, dividend income is the relatable payout investors receive from their stock holdings, offering a steady stream of cash flow. It's a tangible return on investment, arriving in regular intervals, directly reflecting a company's financial health and its commitment to sharing profits with shareholders. On the other side, there's capital appreciation, the increase in value of the stock itself over time. This is the growth investors seek, the potential for their investments to climb, offering the promise of selling at a higher price than the purchase cost. Yet these two financial forces often find themselves in a delicate dance of balance and counterbalance. High dividend yields can signal a company's robust profitability and its ability to return value to shareholders. However, they can also suggest that the company has matured, focusing more on distributing profits than reinvesting them into future growth opportunities. This is where the concept of capital appreciation feels the strain, as reinvestment drives innovation, expansion, and ultimately the increase in stock value. Covered call ETFs enter the scene as a creative financial instrument attempting to navigate this intricate balance. These funds operate on a strategy of owning stocks and selling call options on those stocks, generating income from the option premiums. This income can then be distributed to investors, enhancing the dividend yield of the ETF. It's a strategy that aims to provide the best of both worlds: additional income on top of dividends and the potential for capital growth. However, the trade-off becomes apparent in periods of significant market upswings. The call options cap the upside potential of the stocks within the ETF, meaning if the market rises sharply, these ETFs might not fully capture the growth, as the solid call options may be exercised, requiring the ETF to sell the stock at the agreed price, potentially lower than the market price. The quest for an investment strategy that offers both high dividends and robust growth without compromise is akin to searching for the holy grail in the financial market. Investors yearn for a solution that allows them to enjoy the best of both worlds: the immediate gratification of receiving dividend income and the long-term satisfaction of witnessing their investments appreciate in value. This is why most investors run to the Schwab U.S. Dividend Equity ETF, SCHD. Schwab U.S. Dividend Equity ETF, SCHD. SCHD is a name that resonates well among dividend investors. Famed not just for its impressive track record of growth, but also for its decent dividend yield, which hovers around 3%. The core strategy of SCHD lies in its selection of dividend-paying stocks that are not only consistent in their dividend payouts, but also show promising growth in these dividends. This approach is commendable, yet it begs the question, is a 3% yield sufficient? Considering that the average inflation target hovers between 2.5 and 3%, it prompts a reflection on whether one is truly earning a meaningful income or merely safeguarding their capital against the eroding effects of inflation. The challenge for funds like SCHD in surpassing this yield threshold is significant. The dividend yield of SCHD is intrinsically linked to its portfolio of companies, which typically offers dividend yields ranging from 2% to 4%. Finding companies that are both reliable and capable of offering yields significantly higher than this range is a rare feat. So, when you stumble upon a company offering a dividend yield between 7% and 10%, tread carefully, as it's likely you've encountered what's known as a dividend trap. It's important to understand that dividends can be classified as qualified, and typically, ETFs distributing only qualified dividends rarely offer yields above 3.5%, with 3% being the upper limit of what's common. However, there's another side to the coin. Covered call ETFs, such as JEPI, stand out because they can reach up to 10% dividend yields by leveraging the options market. As previously discussed, the trade-off involves a compromise on capital gains. With these investments yielding non-qualified dividends, it's common to see investments that provide non-qualified dividends reaching yields of 10% to 12%. Also, remembering the impact of taxes is crucial when discussing dividends. Qualified dividends benefit from being taxed at the capital gains rate, which is typically lower than the rate for regular income, which is where non-qualified dividends land. So, the question arises, is there a fund that not only leverages the qualified dividend yield from its holdings, but also capitalizes on the options market to enhance income without compromising capital growth? This is where the DIVO comes into play. The DIVO ETF Unique Solution. The DIVO ETF, or Amplify CWP Enhanced Dividend Income ETF, stands out as a compelling option for investors, balancing the scales between growth and income. Launched in December 2016, it boasts nearly $3 billion in assets under management. Impressively, it offers a dividend yield of around 5%, which towers over most other dividend ETFs. Year to date, the fund has seen a return of over 4%, starkly contrasting to SCHD's 1.85%. Since its inception, with dividends included, the fund has delivered over 100% return, aligning closely with SCHD's performance. Yet, it offers a dividend yield nearly 50% higher than SCHD, positioning itself as an ideal blend of growth potential and dividend yield. This unique positioning prompts the question, how exactly does this fund achieve such a balance? Well, you see, DIVO crafts a unique approach to income generation by cherry-picking stocks from the S&P 500 index while engaging in a tactical call writing strategy. This dual-thrust approach aims to churn out an annual gross income of 4% to 7% through two primary channels: natural dividends and option premiums. By writing short-term covered call options on its stock holdings, the fund manager not only taps into additional income streams, but also harnesses the qualified dividend income these holdings produce. The key to DIVO's strategy is focus on high-quality, large-cap companies known for their robust dividends and earnings growth, a philosophy that echoes the attributes of SCHD. A closer look at the fund's holdings reveals a balanced distribution across several sectors, including financials, consumer defense, healthcare, technology, energy, industrials, and consumer cyclical. Notably, the call writing strategy is meticulously applied to individual stocks on a tactical basis, utilizing only 20% of the portfolio. This selective approach allows the fund manager to pinpoint the most suitable stocks for covered calls, while the remaining 80% of the portfolio is poised for value appreciation, similar to a traditional ETF. The strategy has two significant advantages. First, unlike many covered call ETFs, which allocate a larger portion of their holdings to write covered calls, often at the cost of market performance, DIVO's method ensures a greater potential for capital growth. Secondly, the ETF excels in delivering consistent returns. By blending qualified and non-qualified dividends, with 2% to 3% being qualified and 3% to 4% non-qualified, it maintains a steady dividend yield. This consistency is crucial, especially considering that premium income from call writing can fluctuate with market volatility. This steadiness in dividend yield is a reassuring factor for investors, providing a sense of security that the yield will hover around 5% most of the time. Looking at the fund's dividend track record, barring its inaugural year and the pandemic-induced downturn, the yield has remained remarkably stable. It's evident that this fund has the capacity to both appreciate in value and generate an impressive dividend yield. But what about its approach to risk management? DIVO's risk mitigation strategy. Analyzing the fund's performance during the challenging bear market of 2022 and comparing it directly with SCHD, we observed that it managed to outperform by only losing 1% of its value, whereas SCHD experienced a 4% loss. This resilience can be attributed to the fund's strategic use of covered call options. It's crucial to note that both funds saw similar depreciation rates based purely on price return. However, the superior dividend yield offered by the fund provides a significant advantage during bear markets. Moreover, the fund's performance is exceptionally strong compared with the S&P 500 during the same bearish period. This can be seen in its low beta value of only 0.77, compared to SCHD's 0.88 during the period. For those unfamiliar, a beta value below 1 indicates that a fund is less volatile than the market overall, underscoring its fund's effective risk mitigation strategies. This fund stands as a beacon for those seeking a reliable 5% dividend yield, exceptional capital growth, and outstanding risk management. But the cherry on top? It dispenses dividends monthly, unlike SCHD, which opts for a quarterly schedule. This feature is godsend for income-focused investors and retirees relying on their dividend payouts for daily expenses. Monthly distributions ensure a steady, predictable cash flow, simplifying budget management significantly. Moreover, this frequency enhances the power of compounding by offering more regular reinvestment opportunities, helping to mitigate volatility along the way. Despite its impressive blend of attributes, consistent dividend yield, potential for capital appreciation, and effective risk mitigation, the fund manages only around $3 billion in assets under management. This raises questions about its visibility and appeal in the broader investment landscape. One might wonder whether the fund has yet to capture the investment community's full attention, or if misconceptions exist about its strategy and performance capabilities. Additionally, prevailing market trends and investor preference could steer attention away from this fund despite its compelling value proposition. Understanding the nuances behind this fund's current market position could shed light on growth opportunities and attract further investors' interest, making it a subject worth delving into for those curious about the dynamics of investment popularity and fund growth. The fund's expense ratio stands at a notable 0.55%, positioning it on the higher end of the spectrum. To put this into perspective, for every $100,000 invested, investors are charged $550 in annual fees. This could potentially deter investors at first glance due to its perceived cost. However, The rationale behind the elevated expense ratio is tied to the fund's covered call option strategy, necessitating compensation for transaction fees. Being an actively managed fund that engages in options trading, it naturally exhibits a higher turnover rate than more passive counterparts, like SCHD, which only reconstitutes quarterly. It's crucial to note that the fund's returns have already accounted for the expense ratio, meaning the performance investors see is what they truly get. And there you have it, folks. A deep dive into a fund that merges the best of both worlds, solid dividends and growth potential. Intrigued by this financial gem? Would you consider adding it to your investment portfolio? Share your thoughts in the comments section below. Don't forget to hit the like button if you found this overview enlightening, and subscribe to our channel for more insightful content.